It's interesting to me how, after President Donald Trump's election in November, stock markets and asset prices rallied in response. Nearly everything saw its price increase following the election, whether you're talking about cryptocurrencies, stocks, houses, any kind of asset, the price just increased. There is this widespread enthusiasm that filled the country, and asset prices increased. Now, just a few months later, President Donald Trump's policies are creating panic in the stock market. The initial steps taken by the president, including the recent increase in tariffs, is spooking investors. Now, in my opinion, there's three significant actions President Donald Trump has taken since taking office, and that is, first of all, decreasing government spending, which is not inflationary. It decreases spending from the government sector. It also frees up a lot of individuals that used to work for the government to go and work in the private sector. And these are employees that the private sector covets. They like people that used to work for the government. So that's not inflationary. That's an action that decreases inflation, which is the primary risk in the stock market right now. The second action, of course, the biggest action is the tariffs. The tariffs across the board on nearly every country in nearly every product category is inflationary. That causes an increase in cost of goods sold. It also causes a decrease in economic activity because when people see higher prices, they spend less money. So that's the two biggest actions. And then the third, immigration policy is the third biggest action. And restricting immigration is inflationary because you have fewer people available to work, whether they're working legitimately or illegitimately. Work is work, and that causes prices to go down economy wide. So those are the three big actions in how they're impacting the stock market. So the market is panicking now. And regardless of what you feel about the president's actions, it's not my job here to give an opinion on what I think about the president's actions. It's my job to position my portfolio and my viewers' portfolio in how to react to these changes in the stock market. And I think we're entering an opportunity to buy great businesses at lower prices, which we haven't had this opportunity in a really long time. So this stock market sell-off, while it might continue, I don't know how much longer it'll go. It can continue lower another 10, another 20, maybe another 30%. It might continue, but I'm positioning myself to be ready to be buying at all of these levels. So I'm going to highlight 5 good stocks you can buy right now, undervalued stocks or good values, even if they're not undervalued, which I'll talk about one that's in that position. That I think if you're interested in buying these dips, these are 5 quality companies.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
The first company I'm going to recommend is Amazon. Close to $700 billion in annual revenue, strong competitive advantages in e-commerce and cloud segment revenue, great presence using artificial intelligence to enhance its business, lower cost to serve customers. You can get Amazon stock right now at $192 a share. My intrinsic value calculation, by the way, these are proprietary discounted cash flow valuation models I created and I use myself to value stocks, and I use these for my own decision-making criteria. I've calculated Amazon stock to be worth $325 a share. So because of these recent headwinds, you're able to buy Amazon stock at a relatively low price. Now, the price might go lower from here. So if you've got, let's say, $1,000 to invest, you can break that up into 4 pieces. Start by buying $250 worth. And then if the price goes down further, allocate another $250 until you've satisfied your accumulation desire for Amazon stock. The next one I'm going to highlight is Visa. And this is the one I'm going to say, remember I mentioned in the introduction that not all of these stocks are undervalued. Visa is one of those. I don't think it's undervalued. I think it's fairly priced. Visa's Intrinsic value I calculated at $345. It's selling at $343. That's not enough of a difference for me to say it's undervalued. But what I always say is if I can buy an excellent business at a fair price, I'm always willing to do that. And Visa is one of those situations. It's one of those Hall of Fame businesses where it has an absolutely excellent competitive advantage. Its profit margins are the highest of any company I follow, and it has positive correlation with inflation, which is something that I think is important for investor portfolios as I'm starting to see inflation heating up again, especially as we talked about the policies coming out of President Donald Trump's administration are mostly inflationary. And so Visa gives you some positive correlation. If inflation increases, that's good news for Visa because the company generates revenue as a percentage of transaction value. And if transaction values are going up, Visa's revenue is going up. I think Visa is an excellent business at a fair price, and I think investors would be fortunate to have this in their portfolio. I've owned Visa stock for a few years now. The next one I'm going to highlight is Uber, and Uber is actually my top rated stock to buy right now. I follow over 100 companies, and I've ranked Uber as the absolute best of all of the companies I'm following right now for a combination of factors, including valuation, which I think is undervalued. Uber stock is selling at $73 a share. I think the intrinsic value is worth over $112 a share. I recently purchased Uber stock. It was the most recent stock that I purchased as a result of this stock market sell-off. Uber's primary risk is driverless car technology and how it will impact the business. I think those risks are overblown. I think people are overestimating the growth of driverless car technology. I think it's many years away. And also, not only do I think it's many years away, I also don't think it's going to reach the type of scale that many others are thinking. Many others are thinking in the stock market that the growth of driverless car technology is going to be so vast that there isn't going to be a need for Uber. I don't think that's going to be the case. I think there is going to be driverless car technology, but I don't think it's going to be as widespread as everyone thinks. I don't think there's that much demand in the marketplace for that technology. I think it's a solution without much of a problem for everyone, right? There is segments of the market that could significantly use driverless car technology, but it's not for everyone. And I think Uber survives this risk longer term. I like the value here. The next one I'm going to highlight is Pinterest. Pinterest is one of the most significantly undervalued stocks that I'm following right now. The intrinsic value, I think, is $70 a share. You can buy it right now for a little over $31 a share. Pinterest, as a result of these headwinds, if businesses see slowing economic growth, which is already beginning to happen, advertising will likely decrease and Pinterest's revenue will likely decrease as a result. But these headwinds are short term. Eventually, advertising will recover, as it always does. Advertising is one of those forever industries, in my opinion. There's always going to be advertising one way or another. Businesses will want to advertise to sell their products. Pinterest will be a beneficiary of that massive industry that's approaching $1 trillion in worldwide spending. Pinterest is one that I think buyers can buy here on these dips. And last but not least, DraftKings. DraftKings is an online gaming company that offers people the chance to wager on the outcome of sporting events, as well as in some states you can play regular casino games like blackjack. I think DraftKings is undervalued here. You can buy it for $35 a share. I think it's worth closer to $64 a share. And we've seen in recent times, in recent recessionary times, that gaming is a relatively sticky product. People don't decrease their activity in gaming when their economic prospects are not doing great. They like to speculate, right? And if you want to see evidence of that, look at the price of cryptocurrencies, which is a very speculative asset. The prices are still at very, very high levels. despite the reports we're hearing of people losing their jobs and economic activity being constrained and people having difficulty paying for rent and paying for food because of inflation, yet you still see cryptocurrency prices, which is a speculative asset, at really high levels. That tells me people are not selling these things so that they can pay for their everyday essentials. They're keeping with their speculative assets. And that nature, that speculative nature, is something that can persist and help DraftKings survive these near term headwinds. Longer term, DraftKings is in an industry that's growing, that's taking market share away from the black market, right? Sports wagering mostly happens in the black market in the United States. And so they're taking share. They have a positive correlation with political interests in the states because they add tax revenue to the states, and politicians love extra tax revenue to spend. And so they will be inclined to allow DraftKings to enter into new markets. And it's an online business. So the capital investment required for the business is light. They don't need to spend money on casinos and hotel rooms, etc., etc. They just need a strong website that works well, operate the business effectively, and they could generate profits for the long run. Now, those are five excellent stocks that I think can be great buys here during this stock market volatility. That isn't to say that the volatility, I think, is going to end anytime soon. I think volatility will persist. That's the way volatility works. It works in clusters. Once it starts, it sticks around. It's not something that comes and goes quickly. Volatility is more persistent. It drags along. It takes time to work its way through the market. And so I think there's going to be more volatility ahead. And that's why I would approach this as a segmented or prorated opportunity to purchase, not all at once, but separate your purchase amount into separate pieces and then start making allocations once every couple of weeks, maybe once every week, depending on your taste, depending on your risk tolerance. Adjust your portfolios considerably. That's what I'll be doing. I'm getting ready to make purchases. I already purchased Uber stock a couple of weeks ago, and there are stocks on my list that I'm ready to buy as I move forward in these tough economic times. Hey everyone, I'm excited to announce a brand new private Discord for our channel members at the VIP Discord level. It's a great place to connect with me directly, engage with like-minded investors, and learn more and take your investing to the next level. Spots are limited, so join now before it's too late.